what exactly is happening when you talk about the global picture, and what should one actually brace themselves for. We have Jeff Dennis, who's the independent emerging markets commentator, joining us on the show. Very good morning to you, Jeff. Thank you so much for waiting by patiently. I think today is one of those rare days where we've not had any commentary coming in from Trump this morning with regards to tariff. But how should one actually brace themselves, given the fact that every day you have a new addition to the tariff list?
Well, I think there's a lot of uncertainty, of course, about tariffs, and you've sort of said that on the panel already. There's a lot of uncertainty as to what we get with tariffs and when and who will be impacted by it. But at the moment, as you say, there's not a lot in the way of new narrative. If you look at what the markets are doing, with bond yields having pulled back in the US from 4.8 to 4.5 for 10 years, the dollar being weaker on the year, particularly since the middle of January, it looks to me like you've sort of passed the peak of the Trump trade, if you like, and you've seen some profit taking, you've seen some rotation, and as that happens, and some of these emerging markets have benefited from the weaker dollar, I think investors are still saying we don't know what he's going to do, and we've got to wait a little bit longer, and therefore it's a very nervous sort of period where, as I say, there's no new narrative, but we're not quite sure when the next dramatic announcement will come from Trump on the tariff front. And believe me, I'm pretty sure there will be more.
Right.
So, Dennis, what should one do? Is the simple question. This way, that way, everybody is saying that whatever you're doing, you're losing money. So, is it better not to do anything?
Well, what we're seeing, which is very interesting, which is not what I have been expecting, is you're seeing emerging markets outperform developed markets, not by much, but by about 100 basis points this year so far. Although a lot of that has got to do with China. In my back of the envelope calculation, about 2/3 of the increase in the EM index this year is China, which is up 15% in dollars. So I wouldn't get too carried away with that. The fact that EM is outperforming DM, as I said a moment ago, the weaker dollar has got a lot to do with that, with countries that did poorly last year, like Brazil and Mexico and Korea doing much better. And of course, two winners of last year, India and Taiwan, doing less well. So quite a bit of rotation. My sense is still there is a big threat of higher bond yields because of the risk of inflation in the US, partly coming from tariffs. The wage inflation number in the January payroll report was poor. And at the same time, I don't think the tariff story is over. We're going to get more tariffs. So I would still be cautious about bonds. I would be somewhat more exposed to the US than to emerging markets generally. And I'd be a little bit nervous about some of those markets that have had very strong starts to the year as the dollar has gone down, because I think logically the dollar will ultimately start to rebound again. And in particular, I'm very, very skeptical about the big rally in China for a variety of reasons, not least the weakness of the economy.
Jeff, but when you say that you will be very, very cautious on some of the markets that had a great start this particular year, but what about those markets, especially like India, which didn't have a great start? Because onto the emerging market flows, India has seen one of the biggest selling number on a YTD basis. What's the sense that we are getting here?
Well, I think what's interesting is the data you just put up, which shows that domestic flows have remained positive into the market. Foreign flows have been quite negative, and as indeed your slide is showing now. I think what that means is that on the foreign side, a lot of investors have made the bet at the beginning of the year to rotate out of India and into China, and it's worked pretty well, frankly, because India is down on the year. Now, the problem with that, as far as I am concerned, is that, as I say, I think the Chinese economy is still under a lot of pressure. With respect to India, the reason why it was such a good candidate for rotation is, number one, it did very well last year. Number two, the valuations have, of course, been very high. And of course, you've got that very, very disappointing GDP number for the most recent quarter. My view is still to expect India to rebound from here over the medium to long term. basically the economy growth is going to rebound a little from what you had in the last quarter. You've now got real interest rates, which are around 200 basis points, so the scope maybe for more rate cuts eventually from the RBI, and you've got a tax cut coming through as well. And even if the dollar were to strengthen again, it's not going to strengthen that much, and it's not really going to put the rupee under tremendously heavy pressure. If the dollar rebounds sharply from it, it's going to hit more of those currencies that have rebounded a lot, like the real in Brazil, the Mexican peso, etc. So I would be tentatively and slowly trying to rebuild positions in India based on those arguments, but by the same token, being very skeptical as an EM investor about what's going on in China.
All right, Jeff, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. Well,
Thank
with
you.
this, let's move on.